Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Thank you, intro man. As consistent as ever. Less consistent than I've been with scheduling these things, guys. I apologize for a couple weeks in a row there of having no shows. So trying to get back on the routine of things, getting the live show back up. And we have a brand new guest here with us today. We have Andrew with Capital Mindset. Welcome to the show, Andrew. And then James will be joining us as well. James, we just had was it the third episode or the second episode of, or the third episode of Firm Discussions just posted this week. So
Yep.
Becoming a staple here on Punch Card. So good to have you on the live show as well. But this was a bit of a brainchild of yours, talking about the UK stock market. And potentially it's a source of many maybe off the beaten path ideas for many of us US based investors, that's for sure, or elsewhere across the world, because the UK market isn't the biggest in the world. So like all good value investors, you're trying to find wherever the great value opportunities are, maybe location agnostic to a large degree. So potentially there are some great ideas there. And I think the overarching theme here is to figure out, why is the UK stock market allegedly cheap, or is it cheap at all, I guess is another question to ask. And
yeah, we'll get into that.
yeah. So that'll be kind of the theme of this show. Before we get into that, of course, be sure to subscribe so you don't miss any future episodes, and also all the other content we'll be posting during the week as well, not just these live shows. Of course, it's great if you can join us live, because we love having audience feedback and questions that we can get to during the show. But even if you aren't here for the live show, you can obviously watch the recorded version, and also check out all of our other content, including James's show for Firm Discussions, as well as Contrarian Corner with Mike Sharp. Those have been quite well received so far, and we expect to have some more content coming in the future that is beyond just the live show. So thanks everyone for that. Be sure to subscribe. Check out all the links in the description below, including the affiliate links to ShareSite and Seeking Alpha. You can get discounts there for their premium services, and it goes a long way towards helping the channel, and that's always appreciated. Now, with all that said, James, I think I'm going to kind of hand the reins to you here, because I am no expert on the UK market, and I would like to believe you are. So I'll leave it at that. Where do we start this whole discussion? I guess maybe the first question I'm trying to figure out is the UK market cheap, and how do you define cheap?
Well, first thing I just wanted to mention on when you're talking about other shows, we do actually have an upcoming episode of Firm Discussions featuring Andrew talking about a UK listed stock. So this should be quite a nice sort of build up to that as well.
A teaser.
Yeah, a little teaser. Yeah. And I thought it might be good before we start looking at valuations and so on of different markets, maybe just for people who aren't familiar with the UK markets, what they are, sort of which there are sort of a couple of them, and there's sort of different levels within them, sort of listing levels as well. And then there's some indices. So like if you're looking at trying to judge how to value the UK stock market, generally that's based on an index, and we've got a few different options as well. So I wanted to introduce those first. So principally on the markets front, we've got two markets. There's the main market, which has a standard and a premium listing, and that's a sort of crucial difference there, because in order to be listed in one of the FTSE indices, like the FTSE 100 or FTSE 250, you have to be a premium listed company, and so there is a distinction there. They have to pay a bit of extra money and get some, I think, provide a little bit more information.
Is it a huge fee, or what?
It's quite a bit, but it's also more. It's probably more just that they have to provide a lot more information,
sure,
in their accounts and stuff like that. Perhaps, so it becomes a bigger burden on the company to get that kind of premium listing. So there are quite a lot of examples of companies that would be a sufficient market cap to appear in an index, but haven't paid the money to and gone through the process of of doing so. So they're not eligible to be included in the index. But yeah, so there's the main market, those two. We've also got the alternative investment market, which is often when people are talking about looking for small cap value sort of opportunities, they're often on the AIM market or the alternative investment market, and these typically are sort of like below normally in the tens to hundreds of millions of pounds, and certainly sort of below £1 billion, and pounds to dollars is about I think there's $1.2, $1.20 to a pound or something right now, just for reference, because we're going to be talking quite a bit in pounds. But yeah, then the two, moving on to indices, we have the FTSE 100, which is the one that everybody thinks of when they think about the UK stock market. It's the 100, effectively the 100 biggest companies listed in the UK. And just to give you a few stats about it, its average market cap is £19 billion, so probably quite a bit smaller than something like the S&P 500 average. And it ranges between 1 billion and 164 billion pounds, and I think the median is 7.8 billion. So pretty small. So the actual the middle company is going to be below 10 billion pounds. But some of the really big boys on there are things like Shell. You've got the really big oil titans. You've got AstraZeneca, GlaxoSmithKline, some of the big pharmaceutical companies, and these are the kind of constituents, big banks and insurers and so on. So it tends to sort of be...
As a point of reference, the average for the S&P 500, the average market cap is somewhere closer to like $80 billion based on a quick calculation.
Okay, so close to the max.
If you take out like Apple and all those, maybe it comes down a little bit. But
I'm sure when you remove all the couple trillion caps, then that'll bring it down. But quite a bit bigger, obviously. But go on, please.
Yeah, but so it's kind of fairly seen as old. It's sort of characterized as being like older world stocks. It's a bit like maybe you characterize the Canadian or Australian stock market as well. There's quite a lot of big mining and sort of commodities companies on there.
Sure.
Glencore, so on, Anglo American, BHP. Though I think that's now that's moved to being just Australian listed. But so quite a lot of big, slow moving, old world companies. But then some sort of high tech pharmaceutical and whatever kind of business, but we don't have any of the big tech names like you have in the US, you the FANG stocks or whatever. But in terms of like, and as a result, kind of in terms of return over the last 20 years, if you were to look just at the FTSE 100, I don't think this factors in dividends. It pays us about 3.9% dividend yield right now, and has, I think, been around about the 4% for most of those 20 years. But if you take, just excluding that, the index itself has returned around about 90%. So not amazing, certainly when you compare it to what something like the S&P 500's done.
But that is a pretty substantial dividend yield compared to the S&P. S&P, I think, isn't it closer to like 2% or something like that? It's quite a bit lower. So compounded over.
Yeah, it probably wouldn't be. I think the gap closes quite a bit if you were to reinvest the dividends along the way. But yeah, it's still just on the companies appreciating themselves, capital appreciation. Mm-hmm. It's not been an amazing return over the last 20 years. Certainly not the sort of 10% year or whatever the average you'd expect for the Buffett would say about the S&P 500 or something.
Mm-hmm.
The current PE ratio is about 13. I think I was trying to find the exact. I think that I'm pretty happy with that one. But the cyclically adjusted price to earnings ratio, the CAPE or Shiller PE, I think is, and this is where I'm not quite sure, because it was hard to pin down and get the exact figures for some of these, but sort of closer to sort of 19 or 20. And I think that's because with some of these old world stocks like the oil majors and stuff like that, BP, Shell, they've had really record profits in the last year. And so it's pulled up the earnings above perhaps where they would have historically been. So when you start looking at this sort of average cyclically adjust, we're kind of at a cyclical peak in terms of earnings, is what I'm alluding to there. But yeah, so that's the FTSE 100, fairly mediocre returns, fairly big names. There are some really cheap companies in there. I mean, as an example, I own Aviva, which is an insurance company, and Legal & General is similar. Both of them are FTSE 100 constituents, and they trade at something like a 9% dividend yield each, and they have and if you include share buybacks, it's something like 12 or 13% total sort of yield. And it just the valuations are just absolutely crazy. So you can get, and they're like the top insurer in the UK. Aviva is the top insurer in the UK, second property and casualty insurer in Canada. You know, it's a really big really big successful business, and yet it's trading at such a cheap valuation.
Has it always kind of been around that valuation? Like
no, it would historically, I think, trade around about the 5% dividend yield sort of level.
Okay.
So it really it's probably around about half of where you would expect.
Well, what are people expecting? Like a decline in earnings, some sort of crackdown or something that would justify?
Well, markets got spooked last October with the UK had like a mini budget wobble, and there was like an LDI liability driven investment sort of liquidation spiral that occurred where they had these products, and it was something that did impact Aviva and so on as well, but they were better capitalized than perhaps some of the smaller pension funds and insurers that were exposed to it. But anyway, that kind of risk, that tail risk there, that's sort of looming because of the fact that, and we'll get onto this a bit later, because of the fact that pension funds and insurers have been forced to take on basically most of their assets consist of bonds. They don't really have much in the way of equities, and this was a government mandated kind of thing by regulation. They've actually been prevented from owning equities in many cases for certain.
So are people just factoring in like big interest rate risk? Then is that what's going on?
Pretty much with some of these things, yeah. Is where I would put it for those specific cases, but
right.
But yeah, I've not seen any owning the company, and reiterate, I've not seen anything that particularly concerns me on that front. So it does seem a bit anomalous. But
do they have to hold UK bonds, or can they be international treasuries?
Oh, they have an international mix, yeah.
Okay.
Yeah.
So even with, because I'm just wondering, there were some other risks. I don't know. The other possibility is that they've had a massive markdown on bonds that they were holding beforehand, like when the interest rates, kind of the same thing that happened to banks.
Right.
They hold all these to maturity. They shouldn't have any liquidation risk, but I wonder if that's something that's factoring in as well.
Probably, yeah. I mean, they did have a loss in 2022 as a result of this, but in this particular case, most of it was mitigated by the fact that their liabilities, insurance liabilities and things like that, it was all duration matched, and so these things sort of went down similarly as well. So interest rates moving higher meant that it was easier to cover the insurance liabilities and things. So the way they were capitalized was then dropped, and so there was only ended up being I think a couple of billion or something like that. That was the unrealized losses that overall, once you sort of netted out those two components. But on like a cash basis, the company is very, it's generating an awful lot of cash, and such that it can pay out a high and increasing dividend and still conduct share buybacks and do acquisitions, which it's been doing, and all the rest of it. So there's not really, nothing has been realized, and because it's an insurer rather than a bank, there's no opportunity for things like a bank run or anything like that. So it's just swings of the asset prices and things. But yeah, having a look at so once you move past the FTSE 100 to the top 100 largest companies in the UK, you've then got the FTSE 250, and this is where I was kind of saying where you get some companies that fit the criteria in terms of market cap and stuff, but they're not on the premium listing. So there are some. Which ones end up in this list is a bit mixed, but yeah, this is sort of like, so just to give you some of the figures, the average market cap or the mean is 1.3 billion pounds, and it ranges between 130 million to 4.2 billion pounds, and the median is 1.1 billion pounds. The average CAPE ratio over the last 30 years has been 25, so kind of fairly similar, I guess, to how the S&P 500 has maybe been. I know that it oscillates, but it's certainly around about the same kind of level as the S&P 500. But as of Jan this year, and I think it probably has come down since as well, it was 18.7, so quite significantly below the historical average. And I've actually got I'll show you put some charts up in a second, but the quite interesting thing with the FTSE 250 is, you know how I was talking about the fairly mediocre 90% returns from the FTSE 100. The FTSE 250 over the same period has done over a 250% return. So wow. It's and if I'll just if you
there was 90%, right? So 90
so it's
wow.
Yeah, this is quite phenomenal. I'll show you maybe if I just share my screen.
I'd imagine that's not carried by a few players, because then I feel like the 100 would have done better. Is it just a broad move? Like tons of little holdings that have all done well? I don't know. That seems kind of unlikely.
Well, yeah, I'll break. It might become clearer when I then show you what the smallest one's done as well, so we can kind of get a bit of a picture of the where being sort of in the middle seems to have really done it well. So I'll just can you?
Yeah, I got it right here. What are we looking at?
So this is on the London Stock Exchange website, the FTSE 250. So we've got, along the bottom here, we've got the FTSE 100, giving us our 90% return. In blue, we've got the FTSE 250, which up until we had the big crash in 2020 was actually outperforming the S&P 500 by quite a margin. And then since then, it kind of caught up a bit in sort of up to 2022, and then when the market fell in 2022 and the S&P since has recovered, the FTSE 250 hasn't, so it's kind of lagging, and this is where the kind of valuation gap is at the moment, when I said about the CAPE ratio being 18.7.
I see.
Or something else actually that was quite, this is from earlier this. It's not an amazing, let's see if I can zoom in a little bit. Without paying for seeing
it works all right. So we're looking at the CAPE valuation rainbow, so showing kind of the range.
So this is kind of showing you the bands, because you can see that, you know, even though I said it was the average has been 25, it's kind of oscillated quite a bit, and this is the same thing you see with something like the S&P 500 as well. But these kind of bands give you an idea of if it's moving, if it's mainly sitting within this yellow band, that's sort of like its fair value, you could say. It's sort of historical average. And then at the moment, this was in January, and I think it's probably gone a bit lower now. We're down into sort of the green, where it's starting to get cheap. So I think it gives another one where it's like it's probably getting into the cheap and heading towards the very cheap at the moment.
That's for the FTSE 250.
Yeah, the FTSE 250. I don't have the same one for the FTSE 100, unfortunately, but it's similarly a similar sort of level. And then I have actually got the S&P 500 here as well. This is the Shiller P for the S&P 500. So you can kind of see it is historically quite high at the moment.
Yep.
It's probably been, I mean, this is going back quite a way, but it's probably been closer to the kind of level that the FTSE 100 trades at.
Around a 15
in the past, around about a 15, which is
that's the benchmark I use, is around a 15 PE is like normal, I guess, but there's lots of factors that can change it either way.
So yeah, so you might be thinking, why is the FTSE 250 trading at a higher multiple, and why has it performed so well? And I think some of the answers to this have probably come down to just the company size. As I kind of said, they're kind of like small to mid cap. So you've got like the lowest was 130 million pounds in the index, but the largest is 4.2 billion. So they're kind of in. I mean, when you compare it to some of the tech giants and so on, even the 10 billion pound companies are probably small caps to them. But
right.
But yeah, in the UK, in looking at the UK market, the definition, these would probably be defined as like the small to mid cap sort of range, and that's they're usually sort of domestically focused. So they might be sort of retailers or restaurant chain. There's lots of technology and all sorts of other companies in it, but they're often quite domestically focused. Companies certainly more so than the FTSE 100, which is a really sort of global, as I sort of said, commodities, financials, and all the rest of it, much more global than perhaps the FTSE 250. So it's just kind of like it's that smaller with room to grow aspect of the market. I think it's certainly helping, but they're still big enough to sort of have a much lower probability of bankruptcy. And this is where kind of it gets a little bit interesting, is if I add in so as I was saying, if we then could look at the smaller end of the spectrum and the AIM market, there's a FTSE AIM 100 as well, 100 index, and as you can see, this has not done well at all over the last 20 years.
Way behind.
You've lost money. And this just sort of is trying to illustrate here once you get really small, your bankruptcy risk increases to such an extent that it kind of wipes out the gains that could be made from having outsized growth in your company. So I kind of think that small to mid cap seems to be like the sweet spot for getting your really good performance, outsized returns, but with the lower sort of risk level. That's kind of what I've determined from.
Do you think that's a result of just kind of the policy climate? Because the reputation that I should say, the bias that I have against the UK market is it's even more regulated than say the US markets. Not that the US markets aren't regulated, as they're plenty regulated too. But I've always understood that the UK has a lot more regulations to get through in its business climate. Maybe that's a misnomer, but that's just, as an outsider, that's my understanding. And maybe that punishes smaller businesses even more than if it was a more free environment, perhaps. I don't know. That's just my hunch. Is any of what I'm saying, does any of that ring kind of true, or is that your feeling as well?
The interesting thing with the AIM, because I was saying how the FTSE 250 is quite domestically focused.
Sure.
Well, the AIM index actually has an awful lot of international companies, because it's kind of
interesting. Okay.
It's become a sort of hotbed for companies that are too small to, let's say, quite a lot of US companies on there, for instance. They're too small to affordably get themselves listed on at one of the US exchanges, like the NASDAQ or something. It just was prohibitively expensive. And so their only option if they're in the US would be to trade over the counter. And so the AIM is sort of seen as an alternative to that. So you've got companies like Somero Enterprises, which is I think 80% of its revenue comes from the US, and is headquartered in the US.
Right. Interesting.
You've got Tiny Build, which I mentioned, headquartered in Delaware in the US, and it is a global company. But
yeah, right. That was the first episode of Firm Discussions, by the way. If anyone's interested and has an article in that. Yeah.
And then there's is IWG an AIM listed company as well, Andrew?
Great question. They're on. I don't think they're AIM, but let me just check.
Might be a bit big for AIM, but yeah, there's quite a few. I think I might be wrong in saying this, but I think Boohoo was quite famously an AIM one, and it is one that sort of stayed. But yeah, basically, there's quite a lot of examples of international companies and quite a lot of US companies as well that list on AIM because there isn't really a small cap or a micro cap alternative in the US for them. Really, they'd just be over the counter.
Thomas in the chat says he went through every single business on AIM as a treasure hunt. I found no treasure.
He's not looking very hard. There are a few, but they have a lot of hairs on them, or certainly their valuations imply bankruptcy, as we were describing. But yeah,
but that's interesting. So the mix of it's like a not last resort, but second resort if they can't get into the list. They can't get listed on maybe a U.S. exchange or some exchange that they actually want. They come over here to the AIM, and that's their alternative.
A place, and there is there are some advantage. The reason why there's liquidity and why they can get capital in the AIM as well is that it has there are inheritance tax advantages. So basically, if you buy AIM listed companies in the UK, that money then is protected from inheritance tax if you do it right. So, but
other exchanges aren't.
No, so it's like an incentive to try and get people investing in smaller companies. So it's a bit like the same kind of thing happens if you had enough money and you can invest in like venture capital, startups and stuff. It's also kind of protected from inheritance taxes. So it's kind of a way for the more ordinary people without a lot of money to try and shield themselves without being like an accredited investor and so on.
I feel like there are a lot of unintended consequences there, but we'll leave it at that.
Yeah, but that's kind of like. Sorry, go on.
I was gonna say, I'm assuming that the reporting requirements for these different exchanges are different. So like the AIM doesn't have the same reporting. Requirements for. So yeah, that's like the one thing where it's like we're not OTC, but we're not going to require you to have the same standard as these other markets.
Yeah, it's not, because it just, some things would just be too onerous for a company that's like, there are companies on there with like market caps of £10 million or something, so if we're talking, and that might, it kind of means that if let's say they're doing, some might be doing like just 10 million in revenue in a year or something, to then be paying, I have no idea how expensive things like the Nasdaq are, but it certainly probably end up being quite a bit more than their than their revenue for the year, just to pay that, and to try and to pay for all of the audit fees for the sort of standards that would be required and all the rest of it. So it kind of just becomes too onerous for them to access public capital, so public markets. So yeah, but obviously, and as touching on what the member of the audience mentioned, you might be getting, if you get the gems, you might be getting some outside returns, but there's obviously a much higher probability of picking one that's going to go bankrupt. And this is what, if you just take a bucket of companies, like the top 100 companies on the AIM index, then you're not going to do very well. So it's an index investing approach at this level is not going to work. It's very much a stock picker's domain, investing in the AIM market.
One of the theories I have, just as an FYI, or just a quick point I want to make, is even within the US, if you look at the breakdown of the SPY returns this year, it's very mega cap weighted.
Yep.
And so on a valuation basis, And I know I like look at Yardini research. I don't know if you guys ever use his website. It's an MC. It's just a real quick way to take information, kind of look at a graph. But he breaks out, the relative valuations for like U.S. small, mid, and large cap. And large cap also is very much, I think, I don't want to say overvalued, but they're on the relative valuation basis, they're very much
expensive.
Yeah. And
compared to the rest.
And I think I have just my two theories are, one is people have no idea what's going to happen, but they know that people are going to buy iPhones. So they just, they go and they're like, well, I'll buy Apple. I don't hold any Apple. I'm not a fan of that kind of mindset, but, and the other is maybe like, I think that's it, or that they have lots of cash and little debt so that they can weather a storm and potentially like buy these companies that maybe get hurt if there's bad economics coming up. And maybe that's how they're also looking at UK stocks, is saying, I'm not super sure about these. I could be wrong though. That's kind of like my initial read.
Yeah, well, it's interesting because I'll get on a little bit about the composition of ownership of UK listed shares versus the US, because there's some quite stark differences. Let's just see if there was anything else to mention here. No, I think might move on to what I just mentioned there. Then the ownership. So, let's just as a benchmark have a look at this is what I managed to find for the US. So I don't know exactly how. This is supposedly from the Federal Reserve's financial
zoom in
accounts.
a little bit so we can read that a little bit easier.
Yep. The Federal Reserve's financial accounts of the United States. They pulled the data out of there apparently. So hopefully it's accurate, but feel free to if you've got a better source. But it seems like the point they're trying to make here is that there's much more of a culture of investing in the US, and household ownership of shares, or sort of individuals' ownership of shares, is a large part of the market, because he's sort of making the point here that households directly own sort of 37.7%. Then that through mutual funds, they own another 21.8%. Then there's sort of 6.4% through ETFs, private pensions, 5.4%, and so on. And then sort of foreign ownership, crucially here, is just 15.1%, which I found quite interesting.
I'm wondering for the households how they're separating out mutual funds, but households often own mutual funds. I feel like there's almost some double counting going on here. Well,
I think this is what he's saying here. So he's sort of saying it is households that own equities represented. The next largest holder is mutual funds, and households own mutual funds. So he's trying to make the point that actually the ownership of like US equities is all of these dark green ones added together.
I see.
By individuals. Yeah,
sure.
So it's actually a very substantial part of the market is owned by US citizens.
Right.
So I guess a way to read this would be individuals, or 37.7% of US equities are individuals buying single stocks, or like individual stocks.
I think that's right. Yeah.
Versus, okay.
And then, with this kind of in mind, then if we take a look at the UK, it's a very different picture. So let's try and zoom in again. So this is from the Office of National Statistics, so official data from 31st of December 2020. And here you can see that where the other one was in the US, it was just 15.1% was foreign ownership. 56.3% is foreign ownership in the UK. So barely anybody really is actually investing in the stock market. Very little. There's much less of a culture in.
That's on a much smaller, market cap basis as well.
Yeah,
market cap per capita, I guess.
Individuals is only 12%.
Huh.
Unit trusts, which is kind of going to be fitting into the mutual fund bracket there as well, 7.4%. And then what's really changed, and I'll show you some figures from the past as well, is that pension funds and insurance companies together only own about 4% of the UK market. And historically, it used to be closer to 40% back in the 1990s. And then there was basically government regulation that came in with the collapse of, I think it was actually, I've got it here, Robert Maxwell. So I believe, just for the connection here, this is the father of Ghislaine Maxwell of of notoriety. So he basically died mysteriously, and his company then found out had a massive hole in their pension fund, and lots of people didn't have their pensions. Lots of employees didn't have their pensions covered. Ouch. So as a result of this, the governments have went crazily overboard and regulated the hell out of it. And then we can see what happened here from this graph here. So UK pension funds retreat from UK equities. We went from back in 1997, about half of just over half of UK of assets in UK pension funds were in UK equities. And then this has just been on a downward trend from then. The non-UK equities seems to remain fairly constant. So it'll be like, US and global stocks and so on. But the contribution to bonds has absolutely ballooned and just basically replaced all of the UK equities. So the composition, if you were to look at this graph back in the 1990s, would have been very much these would have been occupying, close to 40% here, and the rest of the world and all these other sort of components would have made up a much smaller share. So there's been a big rotation. Yeah.
Given that data with, that amount of outflow from insurance and pension, which used to be half the market, it actually makes the returns that we have seen like way more impressive, if you ask me. I'm sure there are other factors that would influence that, but that's a huge player being kind of pushed out for one reason or another.
It's really interesting.
This kind of and it's kind of the
pretty good data too. It's good that they have it. It's fun to look at, that's for sure.
Yeah, it's been an interesting journey. I had a few of these pieces. Like I'd read this article before, but I sort of pieced together a few other things this afternoon to get some good stuff to show. But it's it's kind of the crucial thing, and I think this is what this will go into in this article, is that as with the US and having a domestic kind of backbone to the market to sort of shore it up is really crucial. And that's what allows, we all know about companies IPOing and crazy multiples and so on, but that is an important part of the function of a stock market, to be able to allow companies to attract companies to list. And maybe people who invest in them don't get the best deal, but it allows companies to raise capital. It makes, in this case, it's making the US a much more attractive destination for companies to IPO, as we saw with Arm, which is a British company choosing to list in the US instead of the UK, and managed to get a fairly colossal valuation. I think it was like 50 or 60 billion dollars or something, and I think it would have immediately been in the fairly high up in the FTSE 100 index if it had listed in the UK. So yeah, that's kind of like the rotation we've seen here. So quite incredible.
That's a massive rotation in 25 years. We're not talking about like 100. That's a lot. But go ahead, Andrew.
I just have a question, because actually it's interesting looking at this, and now it makes a lot more sense when we heard about UK pension funds potentially blowing up, and you see how much they have in bonds.
Yeah.
And I'm assuming they had to take on leverage, because it's very hard as a pension fund or any kind of long-term fund to be in bonds and be able to pay out sustainably to your members, I would think.
Well, this is basically what happened. So effectively what's happened is all final salary pensions, or defined benefit pensions, if you want to call them, have effectively ended. There's no companies are offering them anymore because they can't get a high enough return over the last 20 years or whatever, as rates have come down on bonds, and they haven't been able to invest in equities. They've not been able to get a sufficient return to cover them. So a lot of companies have been in deficit with their pension funds.
Mm-hmm.
And so they've been trying to offload them to sort of bulk purchase annuity companies. Like Legal & General is a particularly large example of this. But the way these large sort of life insurance companies often do it, in order to get sufficient return, they sell these LDI, liability-driven investment products. And what they're effectively doing is, as you described, they're leveraging the bonds by there's this sort of cycle where they put right derivatives on the bonds that they hold, and then using them as collateral. But then they when we had the sudden crashing of the bond prices, particularly like the 10-year UK gilts, that kind of was the particularly hardest hit one. When they started crashing in price as the yields sort of jumped up 1% in like a few days, the derivatives couldn't sort of catch up, and we ended up with margin calls. And then the reason why we ended up with the particular sort of spike was then that what did they have to use to generate cash? What did they have to sell to generate cash to cover the margin calls? They had to sell the exact same bonds that were being used as collateral for the margin calls. So it ended up with this sort of downward spiral. And then that was when the Bank of England had to kind of had to basically just start saying, right, we're going to buy these bonds off you, and we're going to pay, a higher price in order to stop the spiral. So that was effectively what had to happen. They had to inject some cash into the market to stop it. But it just shows you the vulnerability. They can manage fine. They can manage fine from a slow movement up of interest rates. They're sort of designed to do that. But if you get a sudden jump of like a 1% in a couple of weeks or something, that's enough to basically tip them over the edge, and you end up with these spirals. So this is kind of what we saw in last October. So yeah, it's quite exposed, and it's kind of this is all what's had to happen because they've been reaching for yield, with these things. So if we do end up moving towards an environment with more reasonable interest rate levels, where they don't have to start doing these kind of things, like a lot of these pension funds that were previously in deficits have now suddenly moved into a surplus again, and they're all trying to offload them and sell them to life insurers and so on. And this is all happening because interest rates have moved up to more rational levels. So but there's some interest. Just wanted to finally sort of finish here on by saying that we perhaps all of this stuff came about because of regulation, but with the sort of flagging UK stock market, and when I say sort of flagging, like the top 100 companies, if that's what you want to sort of measure. Obviously, we've said the FTSE 250 has actually shown that there are still great opportunities in the UK, and have been over the last 20 years. But if you were to just go for the biggest companies, which is typically kind of how a country is measured, the stock market's performance is measured, we've been lagging, and a lot of this because we haven't really had any major. We haven't really had the tech IPOs and all the other sort of things that have injected growth into the top 100, companies list. So the FTSE 100 hasn't been able to get these sort of fast growing companies that perhaps the US has had with some of its tech giants and so on. So in order to sort of increase the attractiveness and to try and allow some of the smaller companies perhaps to that have the higher prospects to think about start listing, IPOing in the UK, and to increase that sort of attractiveness of the market, they are now trying to reverse course with their regulation a little bit. They've now allowed, they're passing a law, I believe, at the moment to allow insurers to put something like 5% of their assets back into UK equities with a particular kind of focus on earlier stage companies as well. and there's other sort of measures coming into force to try and encourage and try and get individual ownership of equities increased as well. So sort of tax breaks and various sort of things and other initiatives coming in force. So we might have reached peak regulation, and we might be about to sort of get what's previously been a headwind might start to turn into a bit of a tailwind for the UK market. So that's kind of where I thought it would be a good place to end it.
It's really interesting on the deregulation. What are your thoughts on, because I'm not very, I live in the US, so I don't know how the average UK citizen thinks about this, but let's say the incentives get pushed out for individuals to invest more. And we know in the US, that's a big, like, what do we call it? Indiscriminate bid. Like there's always people just buying the S&P 500, which obviously is like, but if
I don't know about always.
I'm just saying like every 2 weeks, my 401k, I just buy no matter what's going on.
Sure. I get it. Okay, I get it. Yeah.
But I'm not saying that that's a reason to be bullish the US.
Yeah.
But that's part of what we're saying is that there would be a drive for more UK citizens to purchase if you push up these incentives.
Sure.
Why would they buy UK indexes instead of the US? Or is the mentality over there they would buy the UK indexes?
Well, I think they'd have to be incentives to do it. So like they kind of had with the tax breaks for the AIM listed shares, for instance, they're talking about, so we have these things called ISAs in the UK, individual savings accounts, where effectively you have an allowance that you can put £20,000 a year into this account, and it's completely then protected from all tax. So you don't get capital gains, you don't pay any tax on dividends and everything like that. So it's to encourage people to invest into these things. But so effectively what they're talking about doing is having another type of ISA. This is one idea they floated, where if you would have a higher allowance, so let's say 25,000 or 30,000 or whatever they're going to set it to, but only if you're entirely restricted to investing in UK listed companies. So this would be like a way of them trying to pull some money back into the market by giving these sort of incentives for people to do so.
No, it's interesting because, as you know, like IWG, one of the things that I find interesting about it is that they're actually considering moving from being on the London Exchange and then uplisting on the NYSE. And so like there's going to be an immediate, in my opinion, and that's not, there's a lot of other reasons I like it. They're executing well and they're trading cheap. But that's the one thing I've struggled with is UK stocks are cheap. I actually always looked at the FTSE 100, so it's interesting to bring up the 250. I didn't realize, but they're cheap. But what's the thing you always gotta look for is what's the catalyst that's going to make them at least close the valuation gap a little bit. I mean, like I think we're almost at record levels in terms of a valuation difference between US and UK stocks at the moment. Obviously, US we're going SPY versus FTSE 100. I think that's what most people look at.
Yeah.
So it's
and I do think kind of like it's part of that is perhaps, as we've sort of said, there's some justification there because of the different sort of types of companies. But yeah, there are definitely some very undervalued companies in the FTSE 100 as well. As we've sort of been saying, like. Yeah, I think Phil makes a good point actually in the comments there, that most people in the UK probably who do invest probably are putting their money into things like the S&P 500 instead. So yeah, it's I think that's definitely true, Phil. Trying to get a bit of more of a mentality of but I think just generally we have such a low participation sort of rate anyway, that if we could just get people there's educational initiatives or whatever kind of like stuff. Like it's so much more part of the culture to invest in the stock market in the US, isn't it? If you can if we can try and generate some of that culture, which I think what they're trying to do a bit as well, through advertisements or what government education initiatives, whatever kind of stuff, then yeah, that could potentially have a positive impact, but it remains to be seen. But
James, when you're looking at, do you filter, I mean, kind of given what we just went over, where it seems like the magic's kind of in the middle, do you filter for that sort of market cap then? When you're looking at these stocks, do you set like a maximum market cap or anything like that for your initial search?
No, I haven't. I do have some. I do have one company in the FTSE 100, which is Aviva, as I mentioned.
Right.
But it has ended up being actually just coincidentally that most of the companies I own fall within, even if they're not in the FTSE 250, they fall within that sort of market cap range. They're probably around. Most of the companies I own are in the hundreds of millions sort of mark, just below $1 billion.
Okay.
So they've got enough financial clout to keep their head above the water and really minimize the bankruptcy risk. But they're still small enough to have substantial sort of potential upside and so on, growth potential there. But a lot of it comes down to more sort of special situation things as well, just the valuation. Maybe they might not be businesses that would be positioned to grow massively anyway.
Right, sure.
But they're just trading at what I deem to be like half of the book value or something. Yeah.
Thomas asks, what was the thesis for Aviva? Since we mentioned it a few times, I think you mentioned it probably a couple months ago when you were on another live show with me, James. But what was that thesis?
Well, I mean, just as we sort of mentioned a bit earlier, the valuation is incredibly cheap. You're getting something like a 9% dividend yield at the moment. They did another 300 million pounds in share buybacks this year, and there's something that they're probably going to continue doing going forward while the stock's this cheap. I like the management team. So the company, to give you a bit of an idea, it's been through a bit of a period of transformation over the last few years. The current CEO, I think, came in 2020 and has kind of turned the company. It consolidated it, reduced it down to just its core profit centers. So it previously had operations all over the world, and Singapore, lots of East European, China business, all sorts of all over. A lot of European ones, Italy, France, Poland, other sort of places, and they basically just. But all of those distributed aspects of the business were only contributed about 25% of the actual net assets of the company. So they divested all of that and then gave all of that back to shareholders. So we had like they did it through a B share scheme. They basically issued a new type of shares and then converted those all into cash and just gave that out as a distribution to everybody. So everybody basically got like a pound a share back from the share price, and then they reduced the share count, consolidated it down. So they gave back a basic close to, I think it was close to 5 billion, including share buybacks and things like that, of capital, and it reduced their. So there was a really good consolidation. I liked some prior CEOs before that had been much more sort of egocentric, empire building in their approach and wanting to build this massive global business. And so the current CEO now is much more focused on
after that
and so on.
And after that, as you can see here, they saw a big old boost to free cash flow. Is that temporary?
So it's misleading. It's very, with an insurer like this, it's very difficult to use IFRS accounting to really judge it. They use Solvency II mainly so most of their, the easier numbers to follow, and they have things like cash remittances as well, which is the cash that they're subsidiaries effectively have paid up to the parent group,
Okay.
Which does nothing. The sort of parent at the top does nothing except corporate sort of stuff. All of the other components are seen as subsidiaries, and so it just gets like effectively dividends paid up to it, and so that gives you an idea of what the real sort of cash flow that's able to be distributed and deployed is. And so but yeah, the free cash flow numbers you saw there are skewed because basically what happened was when they divested all of the about £5 billion worth of subsidiaries, they then took all of that and they gave it to their investment management arm and invested it all into short-term financial instruments, short-term bonds and things like that, 3 months or year-long government bonds and things. And when they did that, it skewed the numbers and it made it look like their cash flows from operations for that year were like negative. They were reduced by 5 billion or something like that. Oh, I think it actually, I'm probably misremembering. I think it was 7.5 billion actually, the total proceeds from all the divestments. So they took that 7.5 billion, and then the next year when they then took it out in order to pay, I think it looked like their financial arm had just generated out of thin air 7.5 billion pounds, and so like it kind of skewed the numbers the other way. And
yeah,
so
that's what I was asking. Like, is it real or not?
It's not. That's not real, no. But realistically, I think the cash remittances are give you a better idea.
Yeah, but I did see when we're looking at total assets and long-term debt, both have substantially decreased in the last few years. So it definitely is consistent with what you were describing.
And that's why they screen real poorly, huh? Like their revenue growth, like it looks bad. Like usually I don't want to buy a company if I'm screening that's like, oh, they've gone from 28 million to 18 billion, 28 billion to 18 billion in revenues. Usually,
that's it. Yeah. And this is why I don't really use screens so much because, or if I do, I kind of do it just on very simple things like a market cap basis or something, because pretty much all the companies I own, if you were to look at a screen, wouldn't look favorable on various metrics, because it's often, that's where the value is sort of hidden. It's clouded because of that. But yeah, somebody, I think somebody, so basically they focused on their core markets now, which are, they're the number one life insurer in the UK in terms of just the overall number of customers and business size. Their legal and general, which somebody mentioned, is bigger in some areas. It's certainly things like bulk purchase annuities, and its asset management is much big. Arm is much bigger. But Aviva is a much more diversified business. It's much bigger in like the general insurance segment, which is like what you'd call property and casualty in America or Canada. And so it has sort of high net worth businesses, all this kind of stuff is expanding as well. So it's much more diversified, I would say, than LNG, which I think is very much its main sort of area of growth and business line is. I felt it just, when I compare the two, it's just a little bit too concentrated. And I particularly like the management in charge of Aviva at the moment as well, which is kind of why I've gone for them. So those two factors are really good. I really like what I've seen in terms of capital allocation the last few years, in what they've done with the shareholder returns and all the rest of it, and how they've been deploying capital. The acquisitions they've done since have been very targeted, basically adding to existing or enhancing. Very much, they're not spurring off into something new. They're very much enhancing an area of the business that they already had established, and they wanted to grow into that segment, or it complements other areas of the business. It's been very focused, and I think, I'm just liking the management in the business.
One of the things I think is just, it doesn't necessarily impact returns, but I think is cool about UK stocks, or potentially is like with Aviva. They were founded in 1696. Like even before the U.S. was founded, like you're never going to see that. I think the oldest company I know of in the U.S. is A.O. Smith. But I think that's always cool. You know, they've been around for a while.
It is a nice benefit. Nice to have that kind of history. You know, the business is probably not going to disappear in terms of like demand for insurance is not going to disappear, is it? You know.
Yeah. But to kind of summarize, I agree that I think that if you're looking to find value right now, I think that U.S. large cap is definitely overvalued. There's some exceptions. There's a couple of companies that, I mean, obviously, but I also think that for most of us, going into mega caps or large caps is very difficult because basically what we're saying is that I know better than the Bill Ackmans, so on, all these massive hedge fund managers more than them and their teams do. I mean, you can often invest alongside them, but and so I think there's both been a massive sell-off in a lot of these, what we call in the U.S., small caps or mid to small caps, both within the U.S., but also UK and Europe. And I think it creates an interesting opportunity. I think there's been maybe some price dislocation from fundamentals on a lot of these. Kind of like, they're in one of the things I think you need to look at personally, my thought is what's going to be the driver for the valuation to come back to the stock or the price to return to the stock. Because, it could be as simple as like, they're going to be making so much money, they're just going to start buying back their stock and that'll drive the price up, or they'll issue a dividend. What's up, Fabio?
I saw Patriots in the chat.
But yeah, so I think it's an interesting, I do think that there's, what would someone say, treasure hunting? I think there's some treasures to be found in these areas.
There's Thomas in the chat, but he said there was no treasure in what was that in what's it called, the AIM or
AIM,
an AIM. So I guess kind of with that said, I mean, I think you're right on a lot of that, most of that probably, Andrew. I don't know if I'd agree with everything entirely, but I think the core lesson is there's value in all sorts of places. And as things run up in some areas, like we're seeing with a lot of like mega cap stuff, I totally would agree there. It will require some extra digging perhaps to go and try and find value in different places that maybe are a little bit off the beaten path, especially as the market has been kind of heating up here in the US after it went pretty cold for a little while, or at least came back down to earth after a ridiculous like 2020 and 2021. A lot of that fueled by rampant monetary policy. And now a lot of the cool down was also fueled by the same, just in the opposite direction. So I think it's always worth just exploring potential different avenues. And at least in the case of the UK market for us US folks, it's all in English, so that makes it a little bit easier.
Though it is IFRS accounting, so you've got to adjust your mindset for that.
Yeah, right. It's not the same, but it's a little bit easier than maybe some other foreign markets that might have great value, but it just can be hard to wrap your head around it because you just don't understand, one, the culture, and two, the language. So that can make things a little bit difficult. I think this is a really good primer, though, James. I appreciate you taking for pitching the idea and also putting together some of those, compiling those graphics, because I didn't realize that with the way the UK market is owned, because that's one of the questions I kind of had before this going into it, is like, who actually owns UK stocks? And I did not expect to see what I saw, so that was pretty interesting. So thanks for that. I guess anything else from either of you guys before we wrap up here? On UK stocks or stocks in general, what do you got? Anything else?
Well, we've got a good example of an undervalued UK stock coming up in the next firm discussions as we touched
Excellent
on
point.
IWG that Andrew is going to be expertly pitching. So we'll look forward to that. Look out for that, people.
Stay tuned for that. That should be going live in about a week from now, maybe a little over a week from now. once that's all put together, and we'll be posting quite soon. So stay tuned for that. Be sure to subscribe. And even if you don't care about firm discussions, which really is a mistake in my view, you should care about it. But if you don't, we still got this show too. So subscribe for that. And maybe you'll see James and Andrew there again at some point. So regardless, thanks everyone for dropping by, and be sure to check out all the other great stuff in the description below, including a link to our Discord where you can keep the conversation going with other people who are interested in this sort of stuff, long-term value investing, and the ideally in the punch card sort of metaphor doctrine. So, but with all that said, thank you both for coming, and thanks everyone for watching. Until next time.
Thanks for having us.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.